Good morning, everyone. It's the 27th of March at approximately 11 a.m. I just wanted to give you another quick update today. Let you know the Australian market is up for the fourth day in a row, and also obviously this follows a rally in equity markets for 3 days in a row. This is buoyed by the imminent $2 trillion fiscal stimulus package that is going to come through the system. However, this is also combined with 3 million new claims for unemployment benefits, the worst since the Great Depression of the 1930s. Overnight, the leaders of the G20 nations have also agreed to provide a US $8 trillion worth of stimulus. So clearly they are also worried that more needs to be done. This may boost equity markets further, but it may also alert them to dangers that are currently in the economy and may not yet be factored into share prices. The question that really we're considering at the moment is whether or not it is safe to start investing in equities now, utilising some cash and fixed interest stores in your portfolios. What we really need to consider when asking this question is really when will it be safe to resume life as we know it, which will indicate to us when it will be safe to invest more in growth assets. I'm just going to pull up some facts and figures just to give you a bit of an update on where we're at with COVID. So as at the 26th of March, yesterday, there were 471,802 cases, and there have been 14,703 deaths, implying a case fatality rate of 4.5%, which is up from 4.2% a week ago. This week, the caseload is growing by about 11.7% per day, compared with approximately 8.1% per day 10 days ago. But this is slightly less than the 13.1% day rate of 5 days ago. These are really important numbers, and one of the key indicators we're looking at in terms of when we feel is a safe entry point back into Australian and global equities. It may be that there is an early sign of the rate of increase decelerating, but the current rate of growth per day implies a doubling of the number of cases every 6.1 days. If this rate of increase is sustained, it is likely there'll be 60 million cases by the middle of May. That's a scary prospect. Governments have generally been slow to react, and our view is that equity markets have not yet established a firm footing. Even though the markets have been rallying for 4 or 3 days in a row now this week, we do believe that it is unlikely that this will continue, and we do believe that markets will most likely fall again. Equity markets tend to run ahead of economic developments, and adjusting prices down on the basis of increasing uncertainty in the outlook is likely. We may, however, be approaching a turning point in equity markets at some point soon, but again, this really, we believe, comes down to a key indicator, which is the daily rate of increase. If the rate of increase starts to decelerate, it will indicate that it will eventually fall to zero, as it did in China, supposedly. We don't know whether we can trust those numbers coming out of China. But once a peak in the number of infections is reached, governments will be able to claim victory and start loosening social and economic constraints. So really, what we're doing at the moment is focusing on the key indicators that we believe will give us guidance on when to start utilising your cash and fixed interest investments to take advantage of an eventual upswing in the markets. We do believe the initial upswing will be swift. However, the following increases in markets will take anywhere between 12 and 18 months. At this point in time, certainly not the time it took for the markets to recover from the GFC. However, that could change depending on how, again, the indicators move, such as the daily rate of increase. If it doesn't start to decelerate and actually starts to accelerate, then prospects are very different. We do believe that overall, from the peak in February, which was on the 20th of February 2020, to the bottom of the market, we could see anywhere between 30, which we've already been, and 60%, depending on the severity and the length of time that this continues for. So at the moment, we are focusing on those key indicators, we are monitoring them regularly, and we will be in touch with you when and if we feel it is a good time to enter the market and start investing to take advantage of an eventual recovery. Until then, I will try to keep giving you these summary updates of important information as and when it changes. And obviously, we hope, as I've already said, that you and your families are safe and healthy and getting through this shutdown unscathed. I do feel terribly sorry for the thousands and thousands of people that have lost their jobs. It is a hugely unfortunate situation, and I can't imagine how some people are getting by. I hope none of you fall into that scenario. If you do need, please call and I will get back to you as soon as possible. Until then, all the best. Thank you. Speak soon.